Hello to all. Welcome to Exposing the Myths of Retirement Investing. My name is Marty Johannes, and I'm the Careers and Personal Finance Librarian for the Johnson County Library. We are fortunate to have with us this afternoon Emerson Hartzler. Before I turn the program over to Emerson, I want to tell you a little bit about him. Emerson has had a very distinguished career. He served as the director of the Management Consulting Division for Touche Ross, the vice president of New Product Development for Retirement Centers of America, and as the executive director of Cardiovascular Consultants. He holds a bachelor's degree in industrial administration from KU, Rock Chalk, and an MBA with an emphasis in finance from the University of Iowa. Now, when Emerson retired in 2007, and I should say retired in quotes, in 2007, he pursued a new career as a pro bono personal financial advisor. He assumed the role of director of pro bono services for Triune Financial Partners for 8 years until 2015. And then since then, he has continued to maintain an independent pro bono financial practice. Since 2007, he has served over 350 individuals and families in the community, doing all of his work on a pro bono basis, in other words, without charge. Much of Emerson's work with clients involves helping them to plan and manage their income and expenses on a monthly basis so that over time they can achieve financial success. Of all his many accomplishments, Emerson is most proud of his 59-year marriage and of his family. He has 2 children, 4 grandchildren, and 4 great-grandchildren. Today, Emerson is presenting Exposing the Myths of Retirement Investing in 3 sessions. So today's session is about understanding the stock market. The second session, which is on next Thursday, is on taming the emotions that hurt investors. And then the third session is on withdrawing funds during retirement. Now, during his presentation, as questions come to mind, please enter them in the chat box. And we'll pause during the presentation to allow Emerson to answer any questions that you submit. And at the end, we'll have Q&A. So, Emerson?
Thank you, Marty. Let me first share the screen with all of you. So you're seeing what I'm seeing. And this is the last slide of the presentation 2 weeks from now. But the reason I put this up is that I'm showing my email address. This is a PowerPoint presentation I'm going to be using. It has a lot of data, a lot of numbers and things like that in it. And you may want to have that if you're really a masochist for the long term. So be happy to send that to you. It's very easy. I have no proprietary interest in this at all. So if you will send me an email requesting it, I will return this whole presentation to you in a PowerPoint format. So give you a minute to write that down if you're interested. There may be some things in here that you would like to see or review, and I'd be happy to give that to you. Just send me an email. I won't, I'll just return it and provide the information. It's jehmph41@gmail.com. So having said that, okay, so you should be looking at a chart that says Exposing the Myths of Retirement Investing. If you don't see that, let me know. So in terms of investments, my timing has always been pretty bad. And it really got bad in 2007 because, as it turns out, 2007 was probably the worst time, or the second worst time in my lifetime, to decide to retire and start taking money out of my retirement funds rather than putting money in. So by 2010 or so, we were back to where we were. A lot of people got burned, however, and we'll talk about that later on with some graphs and numbers and so forth. So that's my first credential. In the spirit of full disclosure, I have very few credentials to actually make this presentation, and I've had 44 years of working in corporate America, but not really as an advisor. I did study investing in the capital markets in MBA school, and I've again been an investor for 50 years. And in my retirement years, I provide pro bono consulting work. Many of my clients are not wealthy people, and I'm helping them try to get to the place where they might be. So I don't deal with this. I don't generally make recommendations regarding their investments and so forth. They turf that off to the CFPs that I know and love and so forth. So then you might ask the question, well, why am I making this presentation? Couldn't Marty get a CFP or somebody with some credentials to make it? I did spend 8 years with Trillion Financial Partners people, a group of CFPs. They have a lot of data, and I started looking at the data, and you'll see a lot of that today and next week. The data shows some things that were kind of contradictory to what I had been taught about how you invest in your retirement years. And so there's a famous quote, I think it was somebody from the Department of Defense, says they were talking about threats from outside, and he says, well, what do we worry about? What's really a danger? What are the risks? He said, you'd think the risk would be the things we don't know about our enemies. He says, that's really not the most damaging or most scariest risk. The scariest risk is the things that we know that simply are not true. So we're relying on it, and then, so that's the kind of the genesis of this whole thing. I started to find a lot of things that I had been taught about investment in the later years, retirement years, that just they're myths. They're just really not true. And I think people are suffering a lot financially by believing this myth. And so that's the genesis of the presentation and the impetus for putting this all together. So the first myth that I would like to talk about, if I can get the, is that you have, when you get to your retirement years, your planning horizon shrinks and it becomes very short term. And so you ought to invest differently just because your planning horizon is short. Well, this slide has nothing to do with the stock market. It's merely from the Social Security Administration. And it talks about the probability of living to a specific age or beyond if you retire at 65, which I did. If you're a single woman, you have a little bit longer expectancy than a man. That's always been true. It's narrowing a little bit. It's not fair, but that's what it is. If you're lucky enough to live with someone, then you have the highest length of age probability. So to live, if you retire at 65 and live at 75 years, and you're a couple, you get 97% probability of living another 10 years. 15 years is 90%. 20 years is 74%. And to live to age 90, you've got almost a 50-50 chance of doing that. Well, now all of a sudden, you've got a 25-year horizon here when you retire. So why should you invest for the short term? You're still investing for the long term, just like you were when you were 25 years old and started putting money into a 401k. So it's remarkable. We're living a long time. So that's one answer. Well, so I am now 79. Maybe I've got 10 years. I think I've got 20, but you can laugh at that. But even 10 years, that's a fairly long horizon. Then most of us, I think on this call, probably plan to have an estate to pass on when they die. Now, in our case, we've got 2 children. Some of that estate will go to the children. Some of it goes to charity. The children are in their mid-50s. So now, so I live another 10 years. They maybe 10 or 15 years before they need the money. So now all of a sudden, the planning horizon for my investments could be 25 or 30 years. Well, that's a very long time. There's a reason why even some financial planners will recommend a more conservative investment when you get into retirement years. And there's some reasons behind it. But I think when you look at the planning horizon, I don't see anything different about this. There's a rule of thumb that says, you may have heard this, you take the number 100, you subtract your age, that's the percentage that you should be in the stock market. The rest should be in a more conservative investment like bonds. And so last time I looked at my report, I'm 79 years old, so I should have 21% in stocks. And my last report showed I had 98% of all my investments in stocks. So, and the difference between, as we'll discuss later, the difference between in terms of rate of return, bonds and stocks over a period of 20, 25 years is quite remarkable. There's a huge amount of money involved there. So I think it's advice that people are getting that's steering them in entirely the wrong direction. So that's the first myth. Oops. Yeah. So I'm making this presentation, and you might say, well, who else could we have gotten? Well, if you wanted to have somebody to make this presentation who really had the credentials, you could find nobody better than Warren Buffett. I mean, the Oracle of Omaha. So we couldn't get him. His price was too high. Marty couldn't stand that. So they got me. But you don't really have to wonder what Buffett would say if he were giving this presentation. And this is what he would say. In fact, I quote him from the Wall Street Journal a few years ago. Low cost, diversified index funds are the best approach to investing for 95% to 98% of Americans. For 95 to 98% of it, Warren Buffett is saying, you need to invest in low-cost, diversified index mutual funds. Now, what we're going to do over the next several sessions is to unpack this, and we're going to ask some questions about each of those. What does he really mean? Why is he saying that, and how does it apply to you? But that's what he's saying. In fact, he goes on to say, he also says, if he dies before his wife, she is instructed to put 90% of her estate into the Vanguard Index 500 fund and the balance into short-term government bonds. So Warren is saying, even my widow, should that happen, I'm advising her to put 90% of our wealth, her wealth at that point in time, into stocks. So now Warren's not going to put himself in that 95 to 98%. He's obviously in the 2 or 1%. But that's his recommendation. And we're going to really unpack that. So what you're going to learn here is what Warren Buffett is telling you. I'm just quoting him. Interestingly enough, I've had over the last 13 years of retirement, while with the Tryon Folk and on my own, to talk to a lot of people about how they're investing. Very, very seldom do I find this formula in play. And we'll discuss the reasons for that as we go along. Very, very seldom I see it. And that's what Warren Buffett of Oracle of Omaha would tell you to do. So here are the basic investment options for someone with retirement funds. You can buy individual stocks, you can buy individual bonds, and Warren is not talking about this. The problem here is diversification. If you have Warren Buffett's money, yes, you can do this. With my level of investments, I can't buy enough individual stocks or individual bonds to get diversified. And we'll talk about why that's a problem. So you're into mutual funds. We're basically talking about stock mutual funds or bond mutual funds. Those are the options for the investor who wants to be diversified, as everyone should be. And then these are basic investments. Now you've got all kinds of derivatives, options, puts, calls, short sales. Boy, we've heard about short sales lately in the business news. I'd leave that to the experts, AKA fools who want to do that kind of stuff. Now here's a chart, and we'll spend a little bit of time on it because it is very important.
Distillery oscillator. We have also started our real.
Hello, there's some interference there. Okay, so this chart is something if you've gone to a financial advisor, you may have seen this hanging on his wall or her wall. And this is a chart of where the stock market, bond markets, and so forth have gone over time. Now, luckily, I don't know if you've ever heard the name Mike Bloomberg, you probably have. He made his fortune in providing financial data. I mean, that's basically what he still does. His companies still do. But the good thing about finances in the stock market is that we have data. Now, this chart goes through 2018, but we've got information that's pretty reliable going back to 1926. That's 94 years of data. I love data. When I was with the Tryon Group, they've got all kinds of information and all kinds of data. I just spent a lot of time looking at it. It was fascinating, fascinating. So we're going to unpack this a little bit. And this starts with the assumption that you had $1 in 1926. Well, there was a roaring 20s and you had great stock market gains. And then, of course, came the crash of 1929, the worst thing we've seen in the 94 years of data. The second myth that some people will have about the stock market, the bond market for that matter, is that it's risky and you could lose everything. Well, yes, if you had $1 here between 1926 and 1929, you got tremendous returns. You doubled your money almost, but then you got the crash. Well, it didn't go to zero. Zero's down here. Okay, so no, if you'd have kept your stocks and your bonds through the 1929 crash, they would have come back. It would have taken a while, but they came back. And now today, you would, depending on whether you were in small caps or large caps, that dollar, believe it or not, would be somewhere between $7,000 and $20,000. So, you know, the financial advisors who are trying to sell you stocks and bonds, you're looking at this graph and say, hey, look, this is wonderful. And it is, okay? So now you can have more conservative investments if you get older. Well, how about long-term government bonds? That's about the highest return you can get on government bonds. That $1 would have grown to 142. So I ask you, do you want to invest in bonds and get 142 bucks? Or do you want to invest in stocks and get $7,000 to $20,000? Well, that's a no-brainer, right? I mean, why would anybody be down here in T-bills? I mean, that barely beats inflation over the time. And the answer is this graph is a little bit disingenuous because the scale, now here we've got years going along the x-axis, but the y-axis is logarithmic. It's not arithmetic. So we go from $1 to $10, 10 to 100, 100 to 1,000, 1,000 to 10,000. So this looks like really a wild ride in 1929, and it was, okay? But how about 2008, the year after I retired and got hammered? Well, these nice little dips here are almost 50%. You look at the logarithmic line, you're talking about a little over $1,000 versus 500. That's about that much space. And so that kind of a dip was almost as bad as this. The logarithmic scale hides how much fluctuation is in these lines. I lived through this one. I lived through some of these others too, but this was my retirement years. Bang! I got hit the first year, 2008. That was about a 50% reduction in the value of my holdings, and that was typical of the stock market. So the news is this is a great way to earn money over time, have your money work for you. But boy, these are not just little bumps, they're big bumps, and you have to be prepared for that. So that's the story. Yeah, my arrows aren't working, my mouse is working. This is a slide that talks about those ups and downs. This is a line that shows you where the stock market is going. This was the S&P 500 index, different periods. remember Black Monday, I lost 15% of the value of all of my investments in one day in 1987. So that was really fun. This is the 2008 crisis. What I want you to focus on here are the gray areas are the periods where there was a bull market. In other words, the stock market is in a swoon. You can see the 1929 was the longest one. So you can see they come and there's really no pattern. Really hard to predict. This was kind of ugly, but it didn't last very long. The good news is that the non-grade years are when the market is going up. So when you invest in the stock market, about 3 out of the 4 years, you're going to see the stock market going up. Your balances are going to go up, and you're very happy. Okay, 1 out of 4 years on average, and it's very unsystematic. Can happen at any time. Then these things are hard to stomach. But the good news is most of the time the markets are going up, and you feel good about it. But you got to be able to get through these things, and we'll talk about that next week. I can't resist getting into a little bit of trivia and asking the question, how we got bear markets and bull markets. So the bull markets are where the market's going up, the bear markets are going down. And the answer is the terms came into use on the basis of how these animals stalk their prey. The bull will bounce, as the matadors know, will bounce you up into the air and eat you, okay? The bear will stomp you into the ground and eat you. So when things are going down, it's the bear market. When things are going up, it's a bull market. So there you go. You heard it here first. This is a wonderful chart, and it illustrates the difference and what amount of money people may be losing by investing more conservatively than they really need to. This is, I think, 68 years, 1950 to 2018. And here we show what happens in any 1 year period. So take any one of those 68 years, what happened? Well, the worst year of the 68, if you had stocks, the green is stocks, all stocks, blue is all bonds. This is a mixture of 50-50. So if you were invested all in the stock market, you could have lost in value 39% in 1 year. That was the worst year. The best year, you gained 47%, okay? Bonds, you only lost 8 in the worst year. Now that's a huge difference emotionally, okay? But you got less return in total. And then a mixture of the two, you 15 and 33. That's 1 year. However, if you're a long-term investor, this means nothing to you. What is meaningful is longer terms. 20 years is the really meaningful. But even if you move out to 5 years rolling average, you take all the 5-year averages throughout that 68-year period, the worst 5-year period gave you minus 3% per year. You could have survived that. And the best would give you 28% per year for 5 years on average. Wow, great returns, okay? When you move to 10 years, there's almost no possibility of losing money over these 68-year periods. And the high was 19%, 16%, and so forth. And then over a 20-year period, everything makes money. And stocks are high of 17%. The average is 6, 1, and 5. Well, that's interesting visually, but here's what I want you to look at. Over that period of time, which was a pretty good time in the stock market, actually, stocks averaged 11%. Bonds averaged 5.8. The 50-50 portfolio, of course, was a mixture of 8.8. But if you started with $100,000 over 20 years, you ended up stocks at 800,000, bonds at 300,000, and a 50-50 portfolio at 500,000. So if your planning horizon is 20 years, and that first slide I tried to convince you that your planning horizon probably is that, or much longer, actually, if you consider another generation, well, gosh, you want the 811, you want the 311, or even the 542. That's hundreds of thousands of dollars that you're giving up by going more conservatively. So there you go. You want to do that? Fine, but boy, there's a price to pay, and it's big. Now, why are people so afraid of the stock market? Why Why do investment advisors tell you to go to the bond market? And it's very simple, because there's risk. I don't know how many times that term has been thrown out by people in all kinds of news. The friends, oh, I don't want to be in the stock market, it's so risky. Well, what is risk? And so I want to spend a little time defining risk, and I tried to break it down so I could understand it, and hopefully I can communicate to you. Can I admit her? Sure I can. Okay. I've broken it down into 3 parts. Excuse me. The first is business risk. The second is systemic risk, systemic market risk. And the third is inflation risk. And incidentally, inflation risk is the one that I worry about because, I'm not going to go back to work. Inflation, even at 3%, which is the long-term average, I'm going to have twice as many resources 24 years from now because the cost of things are going to double in 24 years. So that's the one in my retirement years that I'm worried most about, with the fixed income and so forth. That's the big one. But here's the one that you hear most often, business risk. And that is the chance a business fails and you lose all of your money. So people come to me sometimes and say, well, I've got money, I want to invest it, but I don't want to take any risk. And I say, well, it's impossible, because if you have money, you are going to take risk. It's going to be one of these 3 or a combination of the 3. Business risk, I got a couple of examples. I grew up in a small town in Ohio, and we were on Route 68. At that time, it was the main route between the Detroit area where cars are manufactured and the southern market. So every fall we would go out as kids. I remember when I was in junior high and high school, we get down to Main Street. There were 3 stoplights on Main Street. It's a big town, 1,500 people, West Liberty, Ohio. And the car transports, big trucks with the cars on them, would stop there at one of the stoplights. It was inevitable. And we would get to see in the fall the new models. And, at that time in the late 50s, they were coming out with, the bigger fins every year, and it was hilarious. But we get to see the new cars. And so somebody's told me back in 1958 that General Motors was a good stock to buy. I would say, yeah, right. They got all these nice cars. They own the market. They're going international. General Motors. Let's invest in General Motors. Well, I lived long enough to see General Motors be called government motors, because many people thought without our tax dollars, General Motors wouldn't be here today. I think their stock sold at $2 a share at some point in time. So the point is, I don't care what company it is. It can be the best company in the world, and they can go bankrupt. So you want to avoid business risk. You don't want to put all your eggs in one basket. People who worked for years, I had a boss who worked for years and years with a very good company, and he insisted upon having stock in that company in huge amounts. He kept saying, that's not the way to go. You're not diversified. You need to own a lot of companies. And people get emotionally attached to companies they work for or companies they've owned for a long time. Big mistake, big mistake. So you must diversify. The only way to do that really practically for most of us is through mutual funds. But it's an easy answer. I own, through my current investment strategy, I own a little over 10,000 different companies through 3 big mutual funds, okay? 10,000 companies. What if one of them goes bankrupt? It's too bad for them, but quite frankly, I don't care, because I've got the rest of them that are going to do fine. So it's easy to mitigate business risk. You merely diversify through mutual funds. These are available to everybody. It's very, very easy. Second one is a little bit more difficult. That's systemic market risk. That is the chance that the entire market takes a hit. And that, of course, happened in 2008. It also happened in 1929 and other periods between the two. Now, what do you do there? Well, this is a longer story. We'll talk about it a lot later on in the presentation. You limit the number of shares sold. So anecdotally, I was with cardiovascular consultants. I was in charge of administratively their pension plan. And it's a pretty good sized pension plan. We had 40 docs when I left, and about $33 million in the plan. Every once in a while, someone would come into my office because they thought I knew something about what was going on because I was supposed to be in charge. I really didn't. But they would say, gee, I open up my statement and, I've lost a whole lot of money in my 401k. The market is down. And I would say, well, you need to have a party. And they would look at me like I had two heads and say, wait a minute, the market is down. I said, well, you're looking at the wrong thing. You're looking at the dollar value of the market. What you need to do is look at the number of shares you own. So every month, you are putting in money to the 401k, you're buying shares and stocks. Okay, the company is matching that. They're buying shares and stocks. They're buying shares on sale today. So they're buying more shares than they would at the market not tanked. So you need to go out and have a party. But what's more, the stocks you already have, some of them are paying dividends. And those dividends are reinvested by, guess what? Buying more shares of stock. So you're loading up on shares, you're buying them on sale every day, every month. Okay, so you need to have a party. And they would always leave shaking their heads, not believing you. If that really is true, for the long-term investor, a downturn in the market is really a time for celebration because if you're buying in, you have dividends paid, you're buying shares on sale. But if you panic and say, oh my gosh, the market is down, I don't know that it's not going to go to zero. I'm going to lose everything. I'm going to get out while I can still lose my shirt and save my skin. Well, then you sell shares that you don't need to sell. So that's the problem. So the antidote to systemic market risk is limit the number of shares sold. If you don't have to sell shares to support your lifestyle, then you don't sell. You haven't lost anything. It will come back. The longest time it's ever taken the stock market to recover from a downturn is about 4.5 years, and that's very exceptional. Usually it's a year or a year and a half, like 2008. Limit the number of shares sold. And then finally, inflation risk is the one I worry about. The safe investments are eroded by inflation, as you saw in that first graph of where the stock market's going. Inflation will almost eat you alive today in these safe investments. So the antidote is invest in the stock market through mutual funds. Very simple. So at that point, I've been talking a long time here, rambling on. Marty, do you have questions that have been submitted? We'll take a few minutes to discuss them, and then I've got about 5 more slides before the end of the session today.
Okay. Yes, I do have one question. What would happen if we see another stock market crash like we saw in 1929?
You saw in the first graph that it wasn't total disaster. It could happen again. I thought in 2008 we might be looking at that sort of thing, but again, here's the deal. If if that tire market takes a hit, then you limit the number of shares that you sell, and you don't get out of the market at that point in time, and it will eventually come back. So there is no, the market's going to fail, is going to go away, we're going to lose all our money. Never has happened. Even in 1929, it did not go to zero. If you had held on to the shares of stock that you owned, you didn't have to sell them to buy food, you'd have been just fine. And as we said, the dollar in 1926 would have ended up in $7,000 to $20,000 in 2018. So it would be tough to live through that. But if you're disciplined and you don't sell shares, people open their statements and I do the same thing. I look at my statement and what's the first thing you look at? You look at the dollar balance. You're looking at the wrong thing. You need to concentrate on shares of stock that you own. That's what you can manage. The market, as we'll talk about later, the market will determine what the prices are, and it's always irrational. It's either too high or too low perpetually. But the shares are what you can control, and so that's what you ought to concentrate on. When you're buying and putting money aside, you buy the maximum number of shares. The market goes down, you should have a party because you're buying more shares. So yeah, you can survive it. You just got to hang in there. It
Okay,
will come
we've
around.
got a couple more questions. Was the growth rate chart over 94 years inflation adjusted?
Good question. I have to read the fine print. No, so the chart, inflation would have taken that $1 to $14. Okay, these numbers would be what the dollar value would be. Okay, so you'd have to, that's what the dollar value would be. So if you adjusted for inflation, it would be less than that, but not much. That's the point. So to beat inflation, here's the difference. Now today, inflation is very low, and T-bills are selling at less than 1%, I think. So it's basically inflation.
Okay, another question. To limit the number of stock shares sold, how much cash should you have in an emergency fund?
Very, very good question. The reason advisors tell you to get into the bonds is again, as we discussed, you're getting older, and so your time horizon is shrinking. It really isn't. However, if you, and this, a good certified financial planner will help you through this process. They'll say, okay, let's say, for instance, that you retired and within the next year or two, you're thinking about buying a little condo in Arizona to spend a few months down there during the winter. And over the last few days, that sounds like a really good idea. So I need a down payment. I need $100,000 to do that. You're crazy having that $100,000 in the stock market, because Murphy's Law will take over and the stock market will be at a very low point at precisely the same time you want to cough up that $100,000, and you're going to sell a whole lot more shares of stock than you plan to do it. Okay, so the point is, if you know you have needs in the near term, 1 to 3 years or so, that money should be set aside. Okay, otherwise it goes into the stock market, because if you don't have to, that you don't need the money, you don't have to sell the shares, you just write it out and you'll come out smelling like a rose, because even in the down period, a lot of your stocks are going to be paying dividends, they're going to buy at sale prices and so forth. So yes, if you have things that you expect to spend that you know of, if you have contingencies, anybody that owns a home, there are things that are going to break. So yes, you should have an emergency fund set aside so that you fund those things out of cash or short-term investments. Very good question. For me, it's 2%. I've got about 2% sitting there in cash. For many people, it might be much more than that. But you need to figure what the contingencies might be. Set aside funds, an emergency fund that should be in cash. But if you don't think you're going to need it, you know you're not going to need it, the next several years, long-term investment goes into the stock market.
Emerson, we have a couple of more questions. Invested money doubles every 7 years. Is that a myth?
Well, it's the rule of 72. So you take the rate of return that you're getting, you divide it into 72, and that gives you the number of years it will take to double. Okay. So if you get 10% rate of return, it's 7.2 years it'll double. Now that's an approximation, but it's really, really close to the detailed math that goes into that. So you just take 72 divided by divided by the interest rate that you're getting, or the return rates you're getting. Over the last 96 years, the stock market has averaged about 10% rate of return annually. Again, that's in the average. Very few years you get 10%. So, in that case, if you're in the stock market and you make 10% a year, your money's going to double every 7.2 years. Inflation is going to double every 24 years historically. So you want to beat inflation? Buy stocks. Good question.
Okay. And from another person, since I'm in my 30s, would it make sense to put a lot in stocks now and then sell and shift the money to mutual funds and bonds in my 50s?
Yes and no. You want to start out with mutual funds. I don't care what money you have, and it ought to be all stock mutual funds. And I would argue I'm 79 and I have 98% of my money in stock mutual funds. I've owned some bonds, long story, but it's been 40 years ago. And I probably took a haircut by doing that. Could have made more money in stocks, but definitely go into mutual funds because that allows you to buy a lot of companies. Like I said, I have 3 mutual funds that I'm in at 10,000 companies. So any one of them goes bad, I don't care. But again, good for you. The earlier you start, the better off you're going to be. But you got to plan on putting that money away and not touching it until you are ready to retire.
Okay. That is it for now.
Good. We'll move on.
Okay.
From there, I think we're right on time. So there are 5 topics we're going to cover next. I think we have 2 or 3 we're going to cover today, and then next week we'll get into the others. And they are, the market is a bid and ask auction. A lot of people don't understand what the market really is. It's very different from the markets you and I visit every day. It's really more like a garage sale than going to a store. Secondly, the folly of trying to beat the market. And this is a really interesting subject. You will hear this all the time. If you listen to business news or advertisements and so forth, you've got people saying, oh, I'm going to get you 400% in the next 30 days. Well, no, maybe. Bitcoin, that's a good one. Let's invest in Bitcoin. But try the market, I said over 96 years has returned stock market an average of 10%, double your money every 7.2 years. Well, really? You want to do better than that. And as we'll find out, most people can't. And most end in disaster. Then we're going to talk about, and this will be next week, the reasons most investors don't get market returns. It's very simple, very easy to understand, and it's really terrible. It's just pathetic. Then I talk about diversification, and I want to unpack that term because I believe in a term called extreme diversification. We'll talk some more about that. And then the perils of being out of the market. So those 5 things are we're going to cover in the next few slides. Interesting. I didn't really understand. I went through graduate school. I studied all this stuff. I invested, and I never really understood the implications of this bid and ask auction. And the prices, you have to understand the prices that people are willing to pay for a stock as they trade stocks are based on the future. So they're looking at, okay, if I buy that stock today, is it going to have a good future? Is it going to make profits? Is the value, they're going to pay dividends? Is the value of that stock going to increase? So I'm looking at, I want to only buy stocks that are, and I'm not talking about you with mutual fund, I'm talking about the traders that really make the market. So they're looking at, what's going to go up. So if I'm a willing buyer, I'm willing to buy a stock if I think the stock's future is bright. Why would I buy a stock that I thought was going to go down, right? So I buy General Motors, I buy Tesla, whatever. I think its future is bright. I think it's going to go crazy in the next few years. A willing seller thinks the stock's future is dim. So if I own the stock and I'm willing to sell it to you, and I think it's going to go way up I'm not going to sell. I'm only going to sell if I think it's kind of run out of gas, And so the willing seller thinks the stock's future is dim. The interesting thing about it is, we talked about Michael Bloomberg. I mean, there is so much data on any company if you want to look at it. And there are tons of people all over the world looking at this stuff every day. Everybody has access to identical historical data right up till yesterday. And there has to be perfect disagreement for a trade to take place and a price to be set. Everybody has the same historical data. This guy thinks the stock future is bright. This guy thinks it's dim. And unless they agree on a price, there is no deal. And you think, there'll never be a deal. I mean, nobody ever agree to disagree, and it happens hundreds of thousands of times every day. So that everybody's looking to the future. They don't know what the future is going to hold. All they have is historical data. There's a ton of it. Everybody has access to it at the same time, basically. And so in that environment, you go to a garage sale, and I had one before I moved 8 years ago. And I gave away some stuff. I had prices on it, but I thought it was worth one thing, and I was a willing seller. The future was dim. The buyer could get in and name a price. That same thing happens in the stock market. It's really fascinating. But you need to understand that. And you say, well, I can foretell the future. Well, I can't, and I don't think you can either. We talked about buying mutual funds, and what Warren Buffett's recommendation is to buy low-cost mutual funds, which are index-type funds, and they in the industry are referred to as passively managed funds. Don't like the word because they aren't really passive, but here's the difference. There are actively managed funds and passively managed funds. The actively managed funds, which are about 80%, I think, of the funds that are out there in circulation today. And I bought actively managed funds for 35 years. I no longer do so because they're expensive. So the active manager picks which stocks to buy and hold, when to buy and when to sell. So they're doing research. Now, most actively managed funds have some specifics. I mean, we're in healthcare, or we're in small cap, we're in large cap, because you can't look at all 15,000 or so and analyze these companies. But they're kicking the tires. They're trying to figure out what stocks are underpriced and when to buy and when to sell. That takes a lot of time and effort. And so their fees that they will charge you range from about 1% to 2%, rough figures, per year of your investment balance. So if you have $1 million, they're going to charge you $1,000 to $2,000 per year to manage that stock. Passively managed funds, they just buy and hold a broad range of stocks that may mirror an index. NASDAQ, S&P 500, talked about the Vanguard S&P 500, which is Warren Buffett's recommendations for his wife, should he pass away before she does. There are all kinds of indexes, and they just buy the S&P 500. They just buy these 500 stocks. And then at the end of the year, the S&P 500 people, that index looks and says, okay, well, we want to track the stock market with the 500 most actively traded stocks. And about 10% of those have changed. Some stocks have grown, some stocks have fallen out. So these people who are running index funds will buy and sell just like the S&P 500 comes in and out. But it doesn't take a lot of research to know what the 500 are. It's publicized. There's administrative costs and so forth. And the fees here range from 0.1, like a tenth of that, to 0.3 per year of the investment balance. Okay, so much, much cheaper to buy. And so there has been a trend recently, people going from actively managed to passive funds, but most of the actively managed funds sell themselves on the proposition that they can beat the market. The passively managed funds are just holding on to the market and trying to mimic the market returns, trying to get that 10% over time. So that's the difference. Warren is recommending this approach, I invest in market-based funds, which are essentially index type funds, very low costs. The folly of trying to beat the market. This is also kind of, and it goes into this bid and ask auction thing. We as Americans are competitive. I mean, it's like Lake Wobegon, right? Where all the men are handsome, all the women are strong, and all the children are above average. So, you know, when you look at index funds and say, well, you're just going to get what the market averages give you. And the word average comes up, and then we rebel and say, well, I don't want to be average. I want to beat the market. Well, you can't. Not over a long period of time. So it's goes against the grain of our American spirit. But the issue is it's not one-on-one competition. I play tennis and I play bridge. Okay. And I'm, you know, it's me against you, baby. I'm out there and I'm going to beat you. Okay. And so that's how we think of this competition. This is not, the market is not a one-on-one competition. It's you against the world. You're trying to beat everybody, other investor in the world or his advisor, okay? And you must buy at the right time and price, and you must sell at the right time and price. So you have to be right twice. It foretells, it involves foretelling the future. Everybody knows what's happened in the past. You've got to foretell the future of doing this, and it's proven to be very, very difficult. So when people say, well, you know, I'm going to actively manage, I'm going to buy and sell, I'm going to get you the right stock, here's the hot tip, they are predicting the future. In fact, we're getting close to out of time here. I want to give you an assignment. It's an easy one between now and next week. Watch an hour of business news. Go to some network, cable, and watch an hour of business news. And track how much of the time of that hour is spent with people essentially foretelling the future. Be very interesting. I'd like to hear your numbers when we come back next week. But you'll see, it's very, very interesting. This is the chart we'll end on. And it's very, very compelling, I think. This is the fraction of mutual funds that beat their benchmark, i.e. the market, for 15 years. And this was a study ending December 31, 2017. They tracked 2,828 stock funds. Now, these aren't Joe Six-Pack people you know, picking stock. These are the professionals that get paid a whole lot of money. And over a 15-year period, a whopping 14% beat the benchmark, beat the market. And those 14% probably aren't going to do it next year. There's another study, I had a slide on it and I lost it. I'd like to show it. It says that if you've had success in the past, you're very unlikely to have success in the future. A lot of reasons for that. It's almost another seminar. But these are professionals. Bonds is even worse, 13%. So if I'm investing for 15 years and I want to go into actively managed funds and want to beat the market, I've got an 86% chance that they didn't. I'd be better off in an index, just mimicking the market. Well, I don't like those odds. So I'm going to go get the market because I got an 86% chance of failing in that case. So that's not pretty. And these, again, are not individual investors. These are the pros trying to do it. They can't do it. It's just the market it's brutal. It's brutal because it's a bid and ask auction. You're playing against the you know, you're against the house. The house is going to win. So I have about 5 minutes till 3. If we want to stop there and yeah, take questions, or we can just go home early, or whatever you want, Marty. It is
Emerson,
now.
we do have a few more questions.
Let's go for it.
So first one, When is the best time to take RMD distribution?
Whenever you have to. This past year we didn't have to, so I wouldn't. And you're required to take them, so you have to take them. And it doesn't matter, quite frankly, sometime during the year. Now it depends on what you're going to do with them. If you need the money, well, you can take it whenever you need the money and not before. If you don't need the money, it doesn't matter. You can take the RMD and reinvest them. You invest the dollars. Incidentally, that's a good subject to talk about. The last year, you didn't have to take RMDs. We probably will have to this year, I'm guessing. But if you have regular IRAs from which you are taking the RMDs, and you have a Roth IRA, you don't need the money. You can take the money out of the IRA, transfer it directly into the Roth IRA, and continue your investments. I have a Roth and I have a regular IRA. My wife has a regular IRA. So we have, for the past several years, taken her RMD and just moved it into our Roth IRA. Now you pay taxes on it. You got to give the money its due, government's due. But the money, and I have the same investments in my Roth basically as I have in my regular IRA, so I don't lose anything. I keep it in the market every day, okay? But the nice thing about a Roth IRA, if you're doing retirement, if you're doing estate planning and you want to give money to individuals who are going to pay taxes, if you can give that money in the form of a Roth IRA, they're not going to have to pay taxes on it. It's a wonderful, wonderful. And Roth IRA is just, it's a miracle on steroids. So that's another strategy you might think about. But if you need the money, take it out as soon as you need the money.
Okay, Emerson, another question. This one from Carol. What do you think of Robinhood?
Well, I don't play in that market. There again, they appeal to people who are day traders or buying and selling stocks like crazy, and there are going to be some tremendous winners, but there's going to be an equal number of tremendous losers. So good luck with that. I have a friend, an acquaintance, that retired, and lady, and she spends every day, all day, day trading, and she loves to do it. It's a hobby. Now she will admit that she didn't. She keeps a lot of money in real investments and limits the amount of exposure. But it's fun to do it, but it's not investing. I mean, actually, if you want to go to Las Vegas, at least you've got good entertainment and food. It's kind of the same thing. It's not investing. It's speculating. It's having fun, and so forth. I know some people who own Bitcoin. I got some advice there. The guy said, well, you ought to take any money that you can afford to lose and invest it in Bitcoin. You might make a fortune, but then you might lose it all. So don't, and my attitude toward money just oh boy, I don't think we have any money to lose. If we don't need it, we ought to give it to somebody else, right? So no thanks.
Okay, well, it's 3:00, so we'll go ahead and close. First of all, thank you, Emerson, for this awesome presentation. I've had the opportunity to view the entire presentation, and I think it's so very valuable. So I'm thrilled that we are able to offer it through the Johnson County Library. And I thank all of you for joining us this afternoon. And please make sure you register for each of the next 2 sessions by going to the events calendar on the Johnson County Library website. And we'll see you next week.